Well, that was very much there. So much eloquence with the economy of words. Very insightful indeed. Good morning, everyone. There, Chairman of FIMM, the members of the board of FIMM, distinguished guests, ladies and gentlemen. Firstly, I would like to thank the organizers for giving me the opportunity to come here and share some of my thoughts with you. It is indeed my honor to deliver the keynote address for this 2013 conference. And judging by the impressive turnout and considering that you had to pay to attend, I would congratulate the organizers for being able to get all of you here. The topics to be discussed by the distinguished industry personalities today appear very interesting, and I'm sure they'll be very insightful and very useful to all of us here today. The theme of this year's event is actually Catalyst for Sustainable Growth, and that's very much in line with what we have for the Capital Market Master Plan number 2, which advocates growth with governance. I would like to share with you my thoughts and views on what would catalyze sustainable growth for the collective investment scheme industry and the challenges moving forward this morning. But before I delve into that, I would like to take you back in time to introduce you to a certain Mr. Abraham Van Katwijk, a man to whom we owe our gathering here today. Now, if you don't know who Mr. Katwijk is, you will find out very shortly. In the 18th century, trading in assets like foreign government bonds was very difficult because of registration requirements. During this time, names of investors in government borrowings were inscribed in a ledger called the Book of Public Debt. Governments were borrowing heavily then too. And investors would receive receipts that needed to be presented physically at the government treasury in order for them to collect periodic interest payments. So as you can imagine, it was very difficult for small investors on their own to overcome the practical difficulties of registering their investments and collecting interest in different foreign jurisdictions. Then the financial crisis of 1772 and 1773 saw British banks going bankrupt due to overexposure to the British East India Company, something we're very familiar with from our history lessons. This contagion spread to the banking houses in Amsterdam. After this, investors began to seek diversification in their investments. And recognizing this desire, Mr. Abraham Van Katwijk, a merchant and broker, established in 1774 the first recognizable investment trust in Amsterdam, called something I absolutely cannot pronounce, but means unity creates strength. This innovative investment trust provided liquidity and diversification to small investors in Holland. And of course, back to Encik Kader's point, really the idea of such an investment vehicle was for the long term. Investments in Mr. Katwijk's trust were diversified into bonds issued by foreign governments and banks, and in plantation loans. Investors in the trust enjoyed diversification to many countries: Austria, Denmark, Germany, Spain, Sweden, Russia, as well as the plantations in Central and South America, which was quite unprecedented at that time. According to some reports, the investment portfolio had up to 100 assets at one point of time, and that's diversification for you. The trust promised a dividend of 4%, and Mr. Katwijk would perform the day-to-day administration of the trust, while 2 commissioners were responsible for the oversight of investment policy. Participation in the trust was via subscription, and subscribed for, anyone who wanted more could only participate by purchasing from other shareholders. So, what's so special about this? If you look carefully, it is what our CISs are today. Elements of a CIS can be found in this trust because there was pooling of funds from investors. There was professional management, there was independent oversight over that management, and it enabled diversification of assets at a low cost. Subsequent to Mr. Katwijk's trust, more investment trusts were established in Amsterdam. And these trusts, particularly those that invested in US loans, became so popular that they were actually the dominant category of foreign investments in Amsterdam in the early 1800s. In the Commonwealth, the first investment trust was established in 1868, and it was known as the Foreign and Colonial Government Trust. It's important to say that up to this point, all the trusts that existed were actually closed-end funds. And as such, the manner in which investors could liquidate or increase their investments were actually quite restricted. This tended to result in the net asset value of units in the trust trading at a premium or a discount to NAV, but not at NAV. In 1924, a new development occurred. The Massachusetts Investment Trust, which was an open-ended trust, was created in the US. This was because during the Great Depression in the 1930s, closed-ended structures traded at deep discounts to NAV. They made closed-ended funds less popular because true value was not being reflected. This resulted in subsequently the popularity of more open-ended structures, which enable investors to buy and sell at the NAV of a fund on an ongoing and continuous basis. Mr. Chadwick has had a great influence on all of us because today the key features of his 18th century trusts, being the pooling of funds, a professionally managed and diversified portfolio that allows investor participation at lower investment and transaction costs, are still found in every CIS. So as you can see, you are actually part of a very, very old industry. CIS manufacturers and distributors alike play a key role in the capital market and have the ability to affect a wide cross-section of society as they provide solutions to small investors' financial needs. The impact of your industry on people's financial well-being cannot be underestimated and needs to be carried out seriously and responsibly. This is why it is important for all of you to put your role as an advisor ahead of that as a salesman. In Malaysia, the investment management industry has grown significantly over the past decade. As at the end of 2012, assets under management stood at 505 billion. This is a seven-fold increase to when we started out in 2002 at 75 billion. Collective investment schemes have been a key engine of growth in this industry. Within the span of a decade, the CIS industry has not only grown, but has deepened with the introduction of new products like wholesale funds and more recently, private investment schemes. All of you played a very key part in this and ought to be congratulated for moving the industry forward. As at the end of 2002, there were 188 retail unit trust funds and the NAV was only 54 billion. 36 of these funds were actually Sharia compliant. By the end of July 2013, there were 600 unit trust funds and the NAV stood at 329 billion. 176 of these funds were now Sharia compliant. Funds for non-retail investors were only introduced in 2006. And at the end of July 2013, there were 184 wholesale funds with a total NAV of 58 billion, and 47 of these funds were actually Sharia compliant. The market penetration rate as at the end of July 2013, which measures how much the NAV of the industry is against Bursa Malaysia's market capitalization, stood at 24% for both unit trust funds and wholesale funds in aggregate, compared to 11.2% of 2002. This means that you have really become a lot more important in the capital markets. Your role has actually doubled. As at the end of 2012, Malaysia's unit trust funds and wholesale funds in aggregate were actually the largest in terms of NAV amongst the Southeast Asian countries. Another victory for you. While retail funds can invest in a variety of instruments today, equity funds still remain the dominant segment and have done so for the last 5 years, accounting for 69% to 81% of total NAV of unit trust funds. Fixed income funds and money market funds in that order are actually the next most popular after equity funds. True to their label, retail unit trust funds have individuals as their major shareholders, consistently holding over 97% of accounts, representing between 72% and 85% of total NAV during that period. So as you can see, the people who are relying most of you are actually the small unit holders. What are opportunities like? I would venture to say that opportunities for the CIS industry remain exciting moving forward. We continue to have very encouraging demographics. There's an expanding workforce, high savings rates, and concerted efforts by the government to transform Malaysia from a middle income to high income nation would also create more capacity to invest. The Private Retirement Schemes Framework was introduced in 2012 as part of the government's initiative to establish a robust and sustainable multi-pillar framework for the benefit of future generations. And this PIS framework and industry would provide further growth opportunities for the CIS industry. Just 2 days ago, the Securities Commission, together with the Thai Securities and Exchange Commission and the Monetary Authority of Singapore, entered into a Memorandum of Understanding to establish the ASEAN Collective Investment Schemes Framework for cross-border offerings of collective investment schemes. And of course, FIMM was represented by Dr. Mariam. Thank you very much for your representation. It's very much appreciated. This is an important development for you because this is one of the initiatives undertaken by the ASEAN Capital Markets Forum as part of the Regional Capital Market Integration Plan endorsed by the ASEAN Finance Ministers in 2009. The impact of this is that the signatories have agreed to adopt a common set of standards to allow fund managers in member jurisdictions to offer collective investment schemes constituted and authorized in that jurisdiction to other member jurisdictions under a streamlined authorization process, which prior to the signing of this MOU and the effect of this MOU was not possible. Fund managers would be relieved from the requirement of complying with more than one regulatory requirement through the adoption of common standards designed to ensure that fund managers have the necessary experience and expertise, and that the CIS is offered and managed based on best industry practices. A separate arrangement will provide mutual assistance in relation to the supervision of such cross-border offerings to non-retail investors was also simultaneously entered into. The framework for retail offerings is targeted to be implemented in the first half of 2014. A handbook will also be issued to provide guidance to fund managers on various administrative and procedural matters, including the application procedures and the use of local distributions in the offering process. So once again, if foreign collective investment schemes are offered in Malaysia, you have a role to play. This cross-border ASEAN MOU will also promote closer linkages between ASEAN capital markets and help create a broader and deeper ASEAN capital market that would build ASEAN as an investment destination and promote the profile of fund managers' expertise within ASEAN. ASEAN managers would then have more choice, ASEAN investors would then have more choice in meeting their investment needs through the CIS available under this regulated cross-border investment framework, where appropriate investor protection features have also been embedded. So indeed, you do have many opportunities, but there are also challenges that you do need to rise up to face. And I think in the opening address, Encik Kader had pointed to two very prominent ones. We find ourselves in interesting yet challenging times where returns are low and investors are searching for yield. And we have to say, investors have also become a lot less conservative than they used to. So today, investors demonstrate a willingness to consider products which they would never have even thought of several years ago. Eager to satisfy the investor demand, of course, product manufacturers have rigorously been innovating new products. However, it is important to remember that such innovation must be undertaken responsibly to ensure that the long-term sustainable growth of the industry is put first and foremost. And very much to a point Encik Kader was making just now. Product manufacturers must consider the whole product life cycle, from the design of the product to the manner in which the product is sold. Needless to say, a business model is not sustainable if your customers lose money on a continuous basis. This boils down to the need for one critical success factor: that players throughout the value chain of a product must ensure that products are appropriate for the target investors and are not missold. To this end, product manufacturers must provide investors with clear and concise information to understand what they are buying and the associated risks. Further, they must ensure that their distributors are properly informed and educated about what they are selling and must monitor these distributors appropriately. Product manufacturers should also provide more training to ensure that distributors fully understand their products and the risk they carry. It is very important to ensure that product risk is not disproportionate to the returns that it offers. Only in this way will you be able to have a win-win and for investors to continue to invest. There are many incidents of recent failures for both product manufacturers and product distributors, and I would like to share with you a few examples which are so apparently flawed. One of the big cases that you might have read about is the Goldman Sachs case. In 2010, Goldman Sachs was found to have misled investors on a collateralized debt obligation that is structured and marketed that hinged on the performance of subprime residential mortgage-backed securities. What Goldman specifically omitted to disclose was the key fact that its client, a hedge fund, played a major role in the portfolio selection process, and the fact that the hedge fund had taken a short position against the CDO. Effectively, it was betting against the people Goldman was selling the funds to. And at the same time, it had also helped select the portfolio. So in this case, investors were not given the correct information, and Goldman had also misrepresented that the securities were selected by an independent party, not one that had an interest opposite to the success of the fund. This resulted in Goldman having to pay $550 million to settle with the US SEC. In February 2012, the UK Financial Services Authority fined Santander UK £1.5 million for selling two of its structured products without the necessary clear key facts information. The company had failed to disclose the circumstances under which the structured products would be covered by the financial services compensation schemes and the limitation of such cover. At the other end of the value chain, we have the product distributors. They are the interface with the investors, and as such have the most influence on investor decision making. Because of how investors place their trust in the advice given by product distributors like UTCs, UTCs must put the interests of investors first and foremost. However, there is a clear danger of unit trust consultants putting salesmanship ahead of this advisory role, particularly because of the way they are remunerated. Such a remuneration structure, which depends on commissions, at best creates a perceived conflict of interest, and at worst results in a real conflict of interest. Principals can help in addressing this conflict too, by looking beyond sales targets for UTCs and incorporating the performance of other, incorporating other performance measures such as the frequency of reviews of a client's portfolio and client retention to ensure that unit trust consultants are fulfilling this role. Inappropriate remuneration structures are a key driver for mis-selling of products. Mis-selling has become a major issue with product distributors globally and has received much attention in recent times. Just this year, UBS was fined £9.45 million by the UK Financial Services Authority for mis-selling an AIG fund. UBS had failed to ensure that it itself understood the product it was recommending and failed to recommend it to the right customers. Customers were not informed that this fund, unlike a standard money market fund, aimed to provide enhanced return through investments in asset-backed securities and floating rate notes. Following the 2007 financial crisis, the market values of some of these assets, as you know, fell tremendously, and this prompted investors to withdraw their investments. The massive withdrawals led to a run on the fund, and it was subsequently suspended. Early on in January 2011, again, the UK FSA had fined Barclays £7.7 million for mis-selling two Aviva funds, and the estimated compensation at that time to investors totaled £60 million. In that case, Barclays had failed to ensure that the funds were suitable for customers given that they were risky funds, and yet many of those who purchased the funds were either retired or nearing retirement. In that case, the FSA also criticized Barclays for unclear product brochures, the inadequacy of training provided to advisors, and the procedures for monitoring sales. It's not just financial institutions that get into trouble. In September 2010, a law firm known as Thornton's Law, which provided investment advice under the brand name of Thornton's Investment Services, was fined £35,000 by the FSA, and one of its partners was separately fined £10,500. Thornton, amongst other things, had used misleading phrases in letters to customers to describe Lehman-based structured products as absolutely no risk to capital. And we all know how true that is. The partner who was responsible for this was actually found to have no experience in the financial services industry. He was also found to have not adequately informed himself about the product. He didn't even know what he was recommending, and failed to put into place adequate systems and controls to collate information about the product. This brings us to a very important point. Unit trust consultants must act professionally and uphold their reputation as advisors. There have been instances even in Malaysia where sales efforts have been so aggressive by UTCs that their professionalism has been brought into question. There was one case where survey forms were distributed by a UTC to a school, and students were asked for sensitive information, including their parents' EPF account balances, with the apparent intention of influencing those parents to withdraw their EPF savings to invest in unit trust funds. In order to maintain the level of professionalism, unit trust consultants must continuously develop their skill sets. They must know the ABCs of the products that they sell and keep abreast with the latest developments in investment strategies and asset classes, as well as their associated risks. It is imperative that their principals support this effort by providing training and tools to assist the unit trust consultants. The challenge of ensuring that investors are treated fairly is not unique to the CIS industry. In fact, all product manufacturers and product distributors face this risk. Recognizing these issues, the SC had issued the guidelines on sales practices of unlisted capital market products, which I'm sure you're all familiar of, on the 29th of March this year. The sales practice guidelines apply to both product manufacturers and distributors. What did we want to do with the SPG? The SPG was actually aimed at safeguarding investor interests and promoting the long-term sustainable growth of the capital market by ensuring that consistent standards are adopted by unlisted capital market products. The SPG requires that investors, 1, be treated fairly, 2, that product highlight sheets be issued, and 3, that suitability assessments be conducted. As I mentioned before, the fair treatment of investors must take into account the whole process of the CIS product value chain, from development to marketing and sales. To that end, the fair treatment of investors must be an integral part of the corporate culture and day-to-day practice of all product issuers and distributors. While the principle of fair treatment applies to all investors at all times, the level of regulation applied may differ for different categories of investors depending on their level of sophistication. The fair treatment principle requires that the product distributors board ensure that the remuneration structures that they apply do not result in any inappropriate selling. So they're also designed to help avoid mis-selling, which we have talked about so much. Product distributors are required to ensure that the product highlight sheet is issued in addition to any offering document that they do issue. The product distributors are responsible for ensuring that investors are given this PHS before any investment decision is made. The PHS should contain clear, concise, and effective disclosures that would facilitate product comparison and responsible decision-making by investors. Clear and concise product information will help minimize incidences of mis-selling, as salient information on the CIS will become apparent to investors. The third thrust of the sales practice guidelines is the requirement for a suitability assessment to be conducted for investors before a recommendation on a product is made. The suitability assessment would allow the distributor to have reasonable basis before making a recommendation to an investor. In order for investors to be safeguarded, Product distributors must know their client and know their product. The sales practice guidelines ensure that there will be a formal process in respect of fulfilling the requirements of Section 92 of the Capital Markets and Services Act, which require that recommendations made by advisors have a reasonable basis. In order not to be unduly burdensome, the SPG also clarifies that product highlight sheets need not be given and a suitability assessment need not be conducted for certain investors who are called accredited investors. Accredited investors include banks and insurance companies and high net worth entities who have opted out of the assessment are also not required to be given a product highlight sheet and a suitability assessment. Given that accredited investors have the capacity to purchase such necessary advice, we decided that it would be unduly burdensome to require product distributors and manufacturers to actually provide them the full suite of disclosures. The requirements set out in the sales practice guidelines would mitigate to a certain extent some of the mis-selling that is happening. However, this will only be successful if the industry embraces the guidelines holistically and in its spirit and does not go down the road of box ticking, which we so often find happening with every good set of guidelines that we produce. The CIS industry should also consider innovative approaches to more effectively communicating about their products to investors. Such approaches must take into account the target investors and their ability to understand the information given to them. Industry should think laterally and is encouraged to be innovative in their approach in assessing whether a product is appropriate for a particular segment. The use of different tools, such as new media, can lead to more effective communication and better outcomes for investors. For example, web-based technology can be used as a means to explain a product's features and risks in educating investors about the product. Another example is the use of color coding to indicate the nature of the product, investment objective, and risk levels. This has been done in India. A simple visual system would also aid in the comprehension of investors on the nature of products. I'm not sure how much time you and people you are close to spend on making decisions about their investments and their financial future, but personally, having interacted with many people from different levels of society with different backgrounds, I believe that people actually do not spend enough time and are not interested in spending too much time on making their investment decisions and reviewing their investment positions. And a survey by ING Direct in Canada seems to actually support this view. Apparently, 51% of Canadians spend 3.4 hours a year planning their CIS investments, but spend up to a minimum of 5 hours buying a television or a computer. So that 200 to 500 Canadian dollar investment is actually more important to them than a 100,000 investment. Because of this, it is actually very important that investment information be communicated in the most effective and expedient manner. Attention spans are quite short, and it is necessary to do what it takes to keep people interested. Whilst we acknowledge the important roles of the product manufacturer and the distributor, we must not forget the central role played by the investor himself. The investor is an important part of this arrangement and bears a major responsibility in protecting his or her own interests and rights. Investors must take responsibility for their investment decisions and at the very least should understand the inevitable correlation between risks and returns for every investment that they make. In this regard, investor education is actually very key. If an investor does not understand the product, he shouldn't buy it, even if it has been recommended to him by his investment advisor. To this end, fund managers and distributors are in a very unique position to educate investors, given your interaction with them, and to empower them to ultimately make the right investment decisions for themselves. In fact, we see this as a very key role from those of you here today. Ladies and gentlemen, investments are becoming increasingly important. Investors rely on people like you to help them make the right choice in where their hard-earned money or life savings should go, in the hope of generating returns for a multitude of reasons, from educating their children to having enough money for food when they retire. Whilst they must be responsible for the investment decisions they make, and there is no doubt they are responsible, product managers and distributors such as yourselves must also step up to meet the trust that has been placed in you. I would like to conclude my address by reminding you of a few key and very important points. The first is that there are expectations of you. People do place their trust in you. I urge you to exceed those expectations. The second is, please give potential investors what they want: responsibly manufactured products coupled with objective advice and ongoing communication. Not what many of them fear that they are going to get, which is a sales pitch followed by poor client communication. As product manufacturers and distributors, you are placed in a unique position to directly influence the financial well-being of investors. People see you as a trusted party, be it as a manager or as an advisor. And as such, please don't see them as mere sales targets. Finally, now you know that your profession has been around for almost 250 years. Please do ensure that the next 250 years will even be brighter than the last 250. Thank you very much.